Morning, Bob.
Hi, Greg.
This is Bob Norton of Norton Accounting Services out of Louisiana, and you're near New Orleans. Is that right?
That's right.
All right. I've known Bob for a few years. We're in a coaching group together. Love talking to Bob about taxes and real estate and how we can pay less taxes. So again, thank you for joining me today, Bob.
Thanks for
And
having me.
give us a brief introduction about yourself and your business.
Sure. Um, I started in accounting like over 30 years ago, working in the corporate world. And then at some point I figured that I grew up to be an accountant. Maybe I should get my CPA license. So I did that. And then while I was studying for that, I discovered the tax rules in real estate and said, oh, I want to learn more about this. And I was already interested in investing in real estate. So I started doing that. And I realized when I was talking to other CPAs that they really didn't understand how real estate works, and they knew that they know the surface level, but not the deep dark secrets. And so that's what I study, and I specialize in that. And being a real estate investor myself, I was learning it for my own benefit, and then I realized I could help other people. So I created a firm specializing in working with real estate investors and realtors. And so that's where we are today.
Yeah, I can speak to that personally. I was using a CPA local years ago, and they did a great job with the business. But then they were asking me questions about real estate, and I'm like, maybe I need to use a more specialized CPA. So a lot of people don't realize that CPAs specialize. They're kind of like doctors. You have an ER doctor, you have a heart doctor, you have a brain doctor. CPAs are the same way. So,
Yeah, well, the thing is, the tax code is so vast. And in fact, when I was working with a CPA firm to get my license, and I realized that I knew more about real estate than everyone else in the firm, I had a break one day and I figured, oh, I'm going to go. They had a library on the wall with a bunch of books, and you go reference something and pull it out, look up a term, and it tells you where in the tax code you can go read it. I figured, let me go figure out where in the tax code it is for real estate, and I'm going to study that and really learn it. And I went to the book and did that. Turns out the tax code is throughout the entire, I mean, the real estate is throughout the entire tax code. There's not just one section, it's everywhere. So I realized that's why no one really understands real estate because it's too complex for someone just to study it in one sitting. You have to learn it through experience and really understand what the tax code is saying. And so I've been studying that for 20 years now and applying it. It's like when I find out some cool strategy or something, whether it's in the tax code or it's just a real estate strategy, I do it just so I can have experience doing it. But then, I add to my portfolio and use that strategy.
well, let me ask you this question then. People always talk about tax loopholes. Are loopholes really loopholes, or were they written in the code?
So it turns out that they're not loopholes per se. The tax code is an economic incentive system. Congress writes things, then they want business owners and real estate investors and essentially and anyone else to do certain things, to spend money in a certain way, and they give you incentives to do that. They give you tax breaks, tax credits. I mean, just recently, buying an electric vehicle was incentivized by Congress. That's been taken away after this year, but it'll come back at some point. So, buying heavy vehicles was incentivized. That actually was for farmers, but they didn't want to say farmers only, so they just put it in there. It turns out everyone took advantage of it, and our whole industry switched from having small cars to big trucks. So, there's unintended consequences in the tax code, and that's what some people call loopholes. But it's like we discover that, oh, it says this, as long as we do this, we get this benefit. Let's do this. Let's structure the deal this way so we get that benefit.
Yeah, that's a great point. Um, at the end of 2025, I bought a hybrid water heater for my house. My
Mm-hmm.
old water heater was still good, but I knew that tax deduction was expiring at the end of 25. And so I went ahead and bought a hybrid water heater so I can get that tax deduction. So that's the government encouraging me to buy more energy efficient appliances, and they're going to reward me for it.
Right.
So let's get into some questions specifically for realtors.
Okay.
If you're a realtor, when they buy a vehicle, does it need to be in a company name to get a deduction?
No, you can get a deduction as long as you use it for business. So you only get to deduct the business use portion. So the secret to this is to make sure that you're tracking your miles, because IRS will ask you that if you ever get audited, but also to be aware of how much you're using it personally or not. If you have another vehicle that you can say you use personally and that you do use personally, like a spouse's vehicle, then try to use that more than your personal vehicle. Now, the downside of writing off the vehicle the first year is that if you don't use it more than 50% the next year, you got to pay all that back because that's called depreciation recapture, and that's for vehicles. Um, and then the other downside for uh, writing off the vehicle is that it's a one-time deduction. Basically it's depreciation. You get to depreciate the vehicle up front the first year up to the business use percent. And then from that point on, you have to use your actual expenses, which is your, actual gas, insurance, that kind of stuff. The mileage rate includes that in it. And so it also includes depreciation in it. So for realtors, if you're driving a lot every year, it may work out in the long run to give you a better overall deduction. But if you need that big deduction that one year, that's available to you.
But what I'm hearing is even deducting a vehicle is not simple. You, you
That's
need an
right.
expert such as yourself to give you the nuances.
Well, since the tax code was created, entrepreneurs have been abusing it as much as they can. So they would find something and they would do it. And IRS keeps writing rules that set that. So if you're a business owner and you buy a vehicle, you have more rules you have to track than if you own a fleet of vehicles and you have employees using them.
Good to know. As for the realtors out there, do they need an LLC to write off business expenses?
No, I get this question from a lot of people. Do I need to open an LLC so I can get my business deductions? It's like, no, you get to deduct business deductions whether you have an LLC or not. Um, with realtors specifically, I tell them you need to get an LLC set up when you first get started because at some point you're gonna figure out the secret to making money, and then it's going to start pouring in, and you're going to need to have an S corp, and you're going to need to elect your LLC to be an S corp. An S corp is just a tax strategy; it's not a legal entity. So it was set up originally for corporations, which are taxable when you set them up, so that small businesses, that's where the S comes in, could create a pass-through entity, and so you pay tax at your rate. You don't pay tax at the corporate rate and at your rate. You just pay it once. Well, the LLC it's a pass-through entity. When you first set up one and you're a sole member, it's disregarded, which means you do not have to file a separate tax return for it. You report it on Schedule C, just like you would if you didn't have an LLC. You're just a realtor. But at some point, you're going to want to elect to be taxed as an S corp, and then an LLC can be an S corp. You just make an election with the IRS, doesn't change anything legally for the LLC. It just now you file a separate tax return. And the strategy for an S corp is you separate your earnings into wages and profits. I'm sorry. Yes, wages and profits. Wages are subject to Social Security and Medicare taxes, which are also called self-employment taxes. Profits are not. So if you're a sole proprietor, everything you earn is taxed as self-employment. So for an S corp, uh, you want to switch to an S corp when your net income after all your expenses, but before you pay yourself anything, is greater than what would be considered a reasonable salary for you. Now, realtors don't really make reasonable salaries, but if you Google average salary for a realtor, it pops up with a number that you can you can start with. And so that's the strategy. So I always recommend everyone set up the LLC. You may not need it for 3 years, but you want your broker to, you want to give a W-9 to your broker and have them send your 1099 to your EIN. And you report that on your tax return until you elect to be taxed as an S corp.
So I would assume with that too, you would want separate checking account, separate accounting for the business versus your personal.
Well, yes, that's a good point. So if you set up an LLC, you'll need to get a separate checking account for it because when you get a check made out to your LLC, you're going to have to deposit it in your LLC account. But if you don't have an LLC, I still recommend you have a separate business checking account. Now it can be just, it doesn't have to be business. The bank charges fees for that, but it could be a personal account that's in your name, but you do all your realtor business through there so you can isolate those income and expenses and you don't have to go through every transaction in your books and your credit cards and all that. So it's just, if you were doing that already and you set up the LLC, you can close the personal account. I usually keep those open for several months, make sure there's nothing set up automatic in there, and then you move everything to the business account.
Okay, good. So what types of expenses can realtors deduct? And then how should they keep track of those expenses?
So you can deduct any expense that is related to your business. And there's some exceptions in the tax code, like life insurance. You might buy life insurance on you and your business pays for it. That's perfectly okay, but life insurance is not a deductible expense. Meals are only 50% deductible. From time to time, Congress makes them 100% deductible, depending on what's going on. When COVID hit, no one was going to restaurants. They made meals 100% deductible as an incentive for people to start spending money. At least businesses start spending money at restaurants again. So what I tell everybody is that when you go to pay for something, if you could answer the question, how does this help me run my business or grow my business? It's a business expense. And you should pull out your debit card for your business. That's why you should have separate, and you pay for that with your debit card. The easiest way when you first get started as a realtor is that if you have a separate checking account, that's basically a list of all your transactions. You can download those transactions at the end of the year for tax purposes and go through and list beside each one what it was for, like office supplies, meals, marketing, whatever it is, so that when you give that to your tax preparer, they can sort the spreadsheet, add it all up, plug it on your Schedule C. And so if you're tracking, if you're spending your business expenses in that account and in your personal account, then it's going to be easier at tax time going through your data. As your business grows, you may want to get some software, and there's a bunch of different ones out there. And there's some that are free, and those are pretty easy to use. You don't necessarily have to have that if you don't have a lot of transactions. If you're a top agent, you have a team, and you guys are cranking through this stuff, you're going to want some software because it's going to be tough to track all that stuff. And so there's various softwares. You can look them up. A lot of people use QuickBooks. QuickBooks is expensive. They have some cheaper versions they sell you, but it doesn't really give you all the features you really need. But you could do that in the beginning. There's a self-employed version, and then usually the version that most people end up with is it costs $100 a month, which is if you're netting after all your expenses a couple $1,000,000, that's almost nothing to worry about. It's a business expense, but if you're not bringing in much money, it's extra money that you have to pay. And
really, think about what your hourly rate is as a realtor or as a business person, and then how long it's going to take you to put all of this information together in February or March and send to your CPA.
right,
I know, over the years I've gotten better systems and keep better records, but it used to take me several days, if not a week, just to organize everything to send it to my CPA. And now I can typically do that in, a few hours. So what's your time worth?
Right.
Um, so what about estimated payments? Is that something realtors need to worry about?
Yeah, so the IRS requires you to pay in 90% of what you're going to owe for the year or 110% of what you owed the year before, whichever is less. So if your sales are going up, you're going to owe more this year than last year. You need to pay in 110% of what you owed last year. If sales are coming down, you could probably do the 90%. Um, so that means that if you have a payroll, which if you're an S corp, you're doing that, you can do this to your payroll. But most people don't even pay attention to this because they have a W-2 and their employer is withholding taxes. Those are estimated taxes. And at the end of the year, they get a W-2, they file their taxes, they get their small refund. Well, when you're a realtor, you don't have anyone withholding taxes for you. You get paid whatever it is you made. So you have to set that aside. So in the beginning, and then you have to make quarterly payments. They're not due on a true quarter. The first one's due April 15th when the regular taxes are due. And then the next one's June 15th, and then September 15th, and then January 15th. So it's not a true 3 months to make a payment. So you got to plan for that. But we still take that if we know what your taxes were last year and you need to do estimates. Our tax software usually spits out estimated tax payments for you. And if you file your taxes early enough in the year, you can start making those. Um, if you're just starting out as a realtor, you may not really owe much tax yet. So you may not have to make estimated tax payments, but you should get in the habit of setting aside a portion of your commissions for taxes so you have a little savings account that you can use. And then because realtors pay two taxes, they pay income tax and they pay self-employment tax. Self-employment tax is 15.3% of your net earnings. And that could be a big chunk of change because when you're a high income earner as a realtor, you don't have a lot of expenses because it's high margin. It's your time basically. So it's like you're not really paying yourself for your time, but you're earning that money. And then the IRS is going to tax you on that. And so you're paying that 15.3, and that's on top of income tax. And if you're like most Americans, they're in the 22 or 24% tax bracket. So if you add that together, that's 37, 38%. And that doesn't include state tax. So you have to add state tax on top of that. So that's a lot. And so but that's not gross commissions get taxed. It's your net after all your expenses. So if you base it on your gross commission, you can set aside a certain percent. I have people starting out with like 25%. Some people do a third. But and then after you do your taxes, you can figure out what is your effective overall tax rate, and you can use that number to go forward. So this number might change each year, but you know, but you should be aware that that's going to happen. It's going to sneak up on you because all of a sudden you're going to have a big tax bill, and guess what? The IRS is expecting you to send in that same amount of money the next year.
So what I'm hearing, based on everything that we've talked about so far, taxes are very specific to individuals and individual situations. How often should, say, a realtor be talking to their CPA to make sure that one, they are maximizing or minimizing their tax payment, um, and making sure that they're taking advantage of all of the tax advantages that are available to them?
So that's a good question. You should speak to your CPA, have a planning session, not just during tax season when you're getting your data and they're asking you questions. That's not really planning. The CPA or the tax preparers work looking in the past trying to get things caught up. But you need to have a meeting. It's probably good in the last quarter of the year to catch them up on what's happened because once you end the year, like right now, we're in January, you can't make any changes to 25. There's minimal things you can do. And if you forgot to do something, guess what? You can't do it. But if you need to make a change, like buy a truck and write off the truck, you have time to make that decision and figure out how to do that if you meet but in the last quarter. So a lot of times it's like for my top agents and top real estate investors, we're meeting twice, at least twice a year. I have some of them that are really that have larger corporations, and we're meeting quarterly and just talking about things. And really, they're asking like, okay, here's what I'm planning on doing. What do I need to know? That's an important discussion to have. And so I usually start out my meetings with my clients with, tell me what your goals are. Tell me what you're trying to accomplish. And then I look at how they're structured and we fix that if we need to. And sometimes that takes time, years in some cases. But we have to do specific moves and specific things. And sometimes it's like, oh, you don't have an LLC yet. Let's get that set up for you really quick. And then that way we prepare that. So, but yeah, I'm usually meeting, at least once a year with most everybody, and then for some planning, and then twice a year with most people, and then more with larger people that's got a lot more activity, especially real estate investors that are doing a lot of creative financing and deals, and because we're talking about planning for 1031s and cost segregations and stuff like that.
So, talking about real estate investors, one of my favorite topics, and 1031s. Um, you see that come up. You see 1031s a fair amount. You hear about them. If a realtor is representing a client who is intending to do a 1031 because they watched a YouTube video on it or saw something on Facebook, can they do that once they've sold the property?
No. So the way that 1031, you're trading one property for another is really what it's based on. But the IRS has a mechanism on how to do that, and they will count it as a trade, which means you can sell it to someone, and then you can buy a property from someone else, but you need a qualified intermediary to hold the funds. You can't touch the funds at either closing. Now you can add more funds at closing if you need to. At either closing, you can put more money in. But if you're putting money in at the closing when you're selling, that means you probably borrowed too much money on the property, and you're having to pay off the note. But you have to set it up first. And so you have to contact a qualified intermediary, have them structure it. The title company or the real estate attorney will send the funds, the proceeds from the sale to the qualified intermediary. They will wire those funds to the title company or escrow company when you go to purchase the property. But if you sell it and you receive the check, you have a taxable sale. You can't do a 1031 at that point.
So once you close and touch the money, if you didn't already have a 1031 set up, the 1031 is dead.
Yeah, there's not an option to do a 1031. It's just tax. And also, if you do pull some, because I have people do this too. They say, I'm getting 150,000 in cash, net proceeds. I need 50 right now, but I want to defer the 100, and they're going to be taxed on that 50. And the IRS assumes that that's all profit. So it depends on, and what I tell everybody, if you want to do a 1031, let's run the numbers and find out how much tax you're going to owe. Because I have had people, because people are afraid of paying tax. But if you don't have a profit on the property, you don't owe any tax. And if you do a 1031, all you're doing is that loss, you're just deferring that loss into the new property. And it's gone. You don't get to use that loss. So, and then you could have had all the cash if you had a loss, and you could still buy a new property. You just didn't have to do the 1031 and pay those fees, because the qualified intermediary charges fees for that. So always do the math first.
Yeah, and the other thing that I've seen people that can happen with a 1031 is somebody will do a 1031, and one thing that we didn't talk about is the strict time limits, 45 and 180 days. But I've seen people do a 1031 to avoid paying taxes. But then because of those timelines, they'll overpay for the property that they're buying, which kind of negates the whole tax savings benefit in the first place.
Right. So that happens quite a bit. So you have 45 days to identify a replacement property from the date that you close. So that's why I like to talk to people long before they do the 1031, because I basically say, you need to start looking now. You need to have an idea of what that target is, and you want to make sure that it's going to be a good investment. because you can only do 1031s for investment properties. So that's properties that you bought years ago and just held it for appreciation, or it's rental property. It could be properties that if you're a business, like an active business, like think about a mechanic who owns his own business and he outgrows that building and he needs to buy another one, he can do a 1031 of that building. That's considered business property. But a flipper or a construction company or a developer, they can't. That real estate is considered inventory, and 1031 is not available for inventory. So they're going to pay tax on it. So unless they can show that the intent of that property was to be a rental, because there are people that will buy a property with the intent of being a rental and they'll rehab it. And especially in the market, the way it's changed in the last few years, they overspend and they realize it's not going to cash flow the way they thought. And so their only option is really to sell it and find a better property. And so in that case, you could argue that it was the intent was it to be a rental. But if you're doing a bunch of flips in the background and you're doing a whole bunch, it gets hard to separate those. But people then they do the 1031 because they talked to their tax preparer and said, oh, you're going to sell that property, you're going to have a bunch of tax, you should do a 1031. So they hire the qualified exchange intermediary, do the 1031, and then they find out they only have 45 days to find a replacement property. And if you're selling a single family home, that's usually not a problem. If you're selling a $10 million commercial building, you may not be able to find something in 45 days. Now you definitely aren't going to be, that's why you have 180 days to buy it. You're going to do due diligence to make sure all the stuff is right of what you're buying, but you still have to identify it. You can identify up to 3 and you only have to buy 1. So, but people tend to buy properties that are not good investments because they just want to avoid the tax. And then they end up spending more money on the new property to keep it going or whatever, or then they end up selling it at a loss later and probably paying tax on it because they deferred tax. So it's always good to do the calculation, how much tax are you going to owe, and you just decide whether it's worth just paying that tax and accepting it. Because if you can't find a property within 45 days or you don't close on a property within 180 days, you have a failed 1031 and you get taxed on the money as if you didn't do a 1031. Plus you're out all the fees for the qualified intermediary.
Yeah, 1031s are very nuanced. There's a lot of details that go into them. It's a very powerful tool, but it's a tool, and it doesn't work in every situation.
Right.
So one of my favorite topics is the real estate professional status through the IRS. So can you talk about that and why it's so powerful and why among real estate investors it's kind of considered the holy grail?
So, sure. So the real estate professional, what it allows you to do is it allows you to deduct passive rental losses against active income from another business or as for W-2. And so the only people
Passive losses they don't carry over to active income. Is that correct?
right. So rental income is passive by definition of the tax code. So if you're a full-time landlord and you're working your butt off, you're talking to tenants, you're doing your own repairs, all that stuff, that's an active business. But under the tax code, it's still considered passive income. And the difference between active and passive income is active income, you have to pay Social Security and Medicare tax on it. Passive income, you do not. So it's a good thing that rentals are passive. But they have also built in the tax code what's called passive loss limitations. So if you have passive losses, and this is from rentals, this could be from stocks or whatever, it's like you can't take it all against your active income. With rentals, it's the cap is 25. You can deduct up to 25,000 against your losses as long as your adjusted gross income before your rentals is less than 100,000. So if two spouses are working and y'all are making more than 150, or a single person, high income earners making more than 150, you can't deduct any of them. They get suspended. They carry forward. They will offset passive income in the future. Rentals tend to make money in the long run. But when you first set up a rental, you might have a loss from that rental. And if, and it could offset the income that you have from your other rentals. If that's the case, and your income is above 150,000, you can't deduct it. But if you qualify as a real estate professional under the tax code, and there's three tests, then you can deduct your rental losses against your active income. So the first test is you have to spend, and this is one that's either the realtor, because a realtor can be a real estate professional, but they aren't automatically a real estate professional. They still have to meet these three tests. They all call themselves real estate professionals, but that doesn't mean they are on the tax code. So the first test is you have to spend more than half your time working on real estate trades and investments. Well, if you're a full-time realtor and you don't have another part-time job or full-time job, you're spending more than half your time because you're only spending your time on real estate trades and investments. Or if you have rentals, that's a real estate investment. The second criteria is you have to spend more than 750 hours a year on real estate trades and investments. Well, if you're a full-time realtor, you're spending that much time easily. And the third test, which is the one that's hard for realtors to pass, is that you have to spend 500 hours material participation on your rentals. So if you've got one rental, I can tell you, you're not spending 500 hours on that rental. Now, if you bought a building and you rehabbed it, and you did the rehabs yourself, well, you could probably spend 500 hours on that. You may or may not spend 750 hours overall, because the 500 is including the 750. But if you're a realtor, you're spending 750 hours just working on helping people buy and sell houses. But if you have a W-2 job and it's in a real estate trade or investment business, then that counts as well. But what I have people who are doctors and they're making $300,000 a year, and they're investing in real estate and they can't deduct any of the losses unless their spouse is a realtor or just doesn't have a job and manages just the rentals, in which case that's the more than half your time. So you have to do that. Now, if you're a full-time landlord and all you own is rentals, all your income is passive, you don't need to, you're a real estate professional by definition in every form of fashion. You don't need to claim it on your tax return because you don't have active income to offset. So, it's like, it's good if you're a high income earner in a business or something and you want to offset your rental losses with that, then you need to find a way to meet the criteria to get there. And it could be usually with a spouse helping is the easiest way to do it.
Who maybe has, so the hard part is meeting the 500 hours of participation in managing the properties. But if they've got enough properties where they can do that, this would be a really powerful tool for them to then offset their 1099 income from their real estate sales business. Is that accurate?
Yes. So as you build a portfolio and start buying properties, you're going to be spending more and more time on them. And the tax law allows you to aggregate all those properties as one property, even though you still report them separately, and then add up that time. So you might spend 10 hours a year on this property, 10 hours on this one, 20 hours on this one. And then it all adds up. And then, of course, you're doing stuff on your property. You're doing administrative tasks, which count, as material producer, because you got to track your income and expenses.
More properties.
Yeah. And then you can also be looking for more properties, right? That helps. But if all you're doing is looking for properties and you don't own any, that doesn't count. That's an investment activity. That's not material participation.
So along with real estate professional status, one of the other things that will greatly accelerate your tax losses is depreciation. So can you talk a little bit about straight line depreciation versus accelerated depreciation and say a cost segregation study?
Sure. So when you buy a big asset for your business, and including real estate investments, and you rent it out or you use it in your business, then you get to depreciate it. The IRS has specific rules on what you can use for depreciation, and they pretty much say you have to use our method, but you can opt to use straight line. Now, a couple of things are built into the tax code where they're essentially straight line. So buildings are one of those. And the IRS has set a residential building and given it a life of 27 and a half years, and you depreciate that straight line over 27 and a half years. And they just arbitrarily came up with that. But a commercial building is 40 years. It's actually 39. So the whether or not the building you buy is going to actually last that long is irrelevant. You're going to have to depreciate for that. But there are components to the building that have shorter lives. And like furniture, fixtures, and equipment, for instance, for a rental are 5 years. So that includes obviously furniture, any fixture, anything you can easily remove from the house just by unscrewing something. So light fixtures, window treatments. But it also includes kitchen cabinets, countertops, appliances, bathroom fixtures. And so those are 5 year property. And then there's 15-year property, which is basically anything outside the house, land improvements. That would be the fence, the driveway, the patio, the shrubbery, anything that you have to install or that you have in there. So by accelerating depreciation, so instead of if you bought a building and you didn't break it down into its components, you would have to depreciate everything over 27 and a half years. This is a residential building. But if you do a cost segregation study, it's a special engineering study where they break the building down into its components, determine what it is, and statistically come up with here's how much you have on 5 year property, here's how much on 15, and they give you this schedules that itemize all this stuff. It's a lot of pages, and but now you're taking a building and you can break it down into shorter lives. Right now, under the tax code, we have bonus depreciation up to 100%. So anything with a depreciable life of 20 years or less can be written off in the year it's placed in service. So usually that's shortly after you purchase it. So if you have a rental and you have to rent it out and it's ready to go when you buy it, you can have it placed in service, within a month. If you buy a rental that's already got a tenant in it, guess what? It's placed in service the day you bought it. So I like those. Even if you evict them afterwards, it was still placed in service the day you bought it. So, but you get to write off that. Now, and that could be anywhere. So when you purchase real estate, you have the building and the land. The land can't be depreciated, but the building can be. And the building is what you break down into components. And so the beauty of real estate in the whole scheme of things is that you get to depreciate the building, even if you didn't pay for it because the bank bought it for you and you're paying off the note and the tenant's paying off that note for you. So you're not actually paying off the note, the tenant is. But what happens is you have cash flow from that property. Hopefully you have cash flow. And you have cash flow from that property, and part of that cash flow is sheltered from tax by the depreciation because you get to deduct that depreciation. You didn't have to pay anything for it. And then you don't pay tax on everything that you've earned on your rentals. So that's why depreciation is important. And with cost segregations, we can accelerate depreciation and goose the depreciation in the first year and have this huge loss to offset income. And then if you're a real estate professional, it flows through and offsets your W-2 income. So I have clients who are high income earners, and we sit down early in the year and figure out, okay, what do you need to buy to wipe out your W-2 income? And you can do the math. You can cut back into it saying, okay, you need to buy a $5 million building. If you have $1 million worth of income, $5 million, you're going to wipe it out and then, or get close to it. But that's the beauty of depreciation and how it works with real estate.
So, like I said, I'm a huge fan of the real estate professional status, the depreciation. So those, and again, those are all things that the government has put into the tax code to encourage individuals to own real estate, investment real estate, and provide housing, for the public, because the government knows that business people can do it much better than the government, and so they're providing incentives for people to do that. So obviously everything, we've talked about a lot today. It can get really complicated. How can people get in touch with you if they want to know more about this or become a client and participate in some of these tax savings?
Sure. So our phone number is 985-690-4498. Our website is nortonaccountingservices.com. That'd be an easy way. There's also a button on there to contact us from that. The email address is info@nortonaccountingservices.com. And, I'm in Louisiana, we mentioned at the beginning. It's like I have clients in 48 states, our activities in 48 states. So since I specialize in real estate, I'm handling it for clients all over the US. So I can handle tax returns pretty much in any state. And the two states I'm not in, it's like I'm not sure there's too many real estate investors in those states. And I'm not going to name them, but there's a lot, the government owns a lot of land in those states. So
Yeah, and people don't feel like that you have to be able to walk into your CPA's office anymore. Um, that's so pre-COVID. Um, you know, Now you can upload all of your documents through a portal. You can do Zoom calls, you can do phone calls. Um, it's very easy for professional services to be in other states, and
right.
you don't have to walk in people's offices anymore.
Yeah, that's right. We have a client portal that they upload data and we upload tax returns, all that. I have clients using that are across town. It's just easy. They don't have to stop by the office. And of course, we use Zoom. We were using Zoom before COVID, and of course, it expanded dramatically. And so I have a lot of meetings. Most of my meetings are, in fact, on Zoom. When they schedule a meeting and they're coming to my offices, really? Okay. Well, it's usually locals. And sometimes, well, it's good to meet face to face, but Zoom is the closest you can get, and it's really convenient using Zoom.
Well, Bob, I appreciate your time today. I think this was some great information for uh, realtors out there and how they can implement this information and hopefully reduce some of their taxes. Again, reach out to Bob, and he'll give you all the ins and outs on what you can do. And again, Bob, I appreciate you taking the time to answer some of these questions today.
Well, you're welcome. Thanks for having me, Greg.